So when we talk about the accrual basis of accounting, we're talking about going through and recording things, events and transactions, not necessarily when the cash happens, like most of us do when we record in our checkbooks, but when the actual economic event occurs. And the reason that we do that is because sometimes the cash and the economic event are disconnected. And we have to go through and put the economic effect of the transaction in the period in which it occurred, not when the cash occurred. That's for something called the idea of looking at the different periods, and they talk about the time periods for accounting, so we can see if this month had a good income and revenue, if this expense had a good that next month had a good income and revenue. We try to figure out and match it to the appropriate period. So accrual accounting is where we go through and we record items in the periods in which the event occurred, not when the cash occurred. They talk about the revenue recognition principle in 97, and that's the idea is that companies record the revenue in the accounting period in which the performance obligation is satisfied. In other words, the period of time in which they've actually earned the money, even if the cash hasn't happened yet. The revenue, or the expense recognition principle, which is also called the matching principle, says that we match the expenses with the revenues that were generated. So if we used expenses to generate revenues, we match the expenses in the same time period that the revenue was generated. So if we do some work and our employees are doing the work and we're going to pay the employees, but we aren't going to pay them until the next month, we want to make sure that the expenses for those employees doing the work are matched in this month when we did the work and received the revenue for doing that work, not in the following month when they're actually going to be paid. So the matching principle says we have to go through and record things. So that leads us to the need for adjusting journal entries, which are basically where we need to go through and put the revenues and expenses in the right time period. Now, adjusting journal entries are always going to affect, on one side, a revenue or expense account, because we're trying to properly place revenues or expenses in the right time period. The other side of the entry is always going to be affecting an asset or a liability account. And there's two different types of adjusting journal entries, two major categories, okay? And they have them listed on the bottom of page 98, deferrals and accruals. I like to look at them this way, okay? Deferrals are what happens when the cash happens first and the event happens later. So cash first, the economic event is later. Accruals are just the opposite. The event happens first, and then the cash follows later. And this can happen for both revenue items and expense items. On the deferrals for revenues, for example, we might go through and actually receive a prepayment from a customer who is going to pay us for doing some work that we haven't earned yet. So we have to record an obligation to do that work, a liability, but of course we also show the increase to cash. You can also have a deferral on an expense item. That's where we go through and we make a payment, like a prepaid item, and we're going to use that up later. So maybe we pay our rent in advance 2 months to our landlord. Cash goes out, so an asset is decreased, but then we've also have a prepaid asset that we can use later on to offset an expense. On accruals, it's the opposite. We're going to have the event first and the cash is going to follow later. So on a revenue, that's more common where we've done the work and we're going to send a bill out, but we haven't gotten it done by the end of the month. So we record an account receivable as an asset, and then we show an increase in the revenue account because we did the work, we've earned it, people owe us, but they aren't going to pay us till later. We also have accruals for expenses. That would be where we've ordered something or we've got something, some service, but we haven't paid for it yet. So a good example are wages for employees. Maybe we pay people every 2 weeks, and so at the end of the month we need to show the expense for wages for, say, the month of September, but people aren't going to be paid until the 5th of October. Well, at the end of September, we've got to record that period of time that the people work for us in September, so September is properly recorded with the expenses, even though they're not going to be paid for those days until October. So we would record a liability in accounts, or sorry, in salaries and wages payable, and then we would record the expense to put the expense in that time period. So again, every adjusting journal entry is going to have one side an adjustment to a revenue or an expense account, and the other side an adjustment to an asset or liability account. You have a lot more of the accruals than you do with deferrals because it just works out that way. You know, there's a lot more people who want to get something now and pay later. So as a result, that's the more common one than the deferrals. Now, over on